Please welcome your panelists for Trends in Venture Capital, moderated by Global Co-Head of Technology Investment Banking at Jefferies, Cameron Lester.
Okay. Welcome. As you just heard, we're going to be talking about venture capital, but more importantly, we're going to talk about globally how capital is coming into various sectors of various economies and changing the way we live, the way we work. And today we've got a group of really exciting panelists here who represent venture capital from different parts of the world, as well as different sectors and stages. So we'll start, why don't we start on the end here with introductions, and we'll go down the list. Ella, if you want to start.
Hi, everyone. Thank you for being here. As you said, we're a group of very excited panelists. Thank you for sticking around the last day. My name is Ella Amade. I'm a founding partner at a venture capital firm based in San Francisco called 50 Years. So we invest in the US, with a few investments in Canada, and our investments lie at the intersection of 1 billion revenue potential, solving big systemic problems in the world, and deep tech. So where technology, in essence, can be successfully deployed to solve some systemic problems in the world. And we think there is a new wave of millennial entrepreneurs, and there's solid data to back that up, that are specifically looking at business and massively profitable business as a way of solving those big systemic problems in the world. So specifically, what we do is we invest in food technologies, and we're one of the most known investors in cellular agriculture. So this idea of, instead of farming animals, farming cells directly, we invest in synthetic biology, diagnostics, autonomous future, satellite internet, and many other domains where we're generalist fund.
Hi, I'm Jalak Jobanputra, founder of Future Perfect Ventures, which is an early-stage fund based in New York, but investing globally. I've been a VC since '99, was an investment banker in media, telecom, and tech before that. Was fortunate enough to work on the Netscape IPO in '95, and really became kind of enamored with the potential of the internet, and started investing for Intel in Silicon Valley in '99, was there through the boom and the bust. And about 5 years ago, after being at other funds back in New York, I just saw a lot of gaps in the VC landscape. One was, I thought most US VCs were not thinking globally. I was born in Nairobi, I'm Indian, I've lived around the world, and knew that the next 3-4 billion people coming online were going to be coming online not from the developed world, and this was going to create or give the opportunity for new business models to start to emerge. The other element was very tied into that, which is the proliferation of smartphones, smart devices, the kind of reduction in the cost of processing power and storage. And I felt like all of those factors combined were going to create the next wave of technology innovation that would be unlike anything we had seen before, because it would be the first time it would be global. And I also went to my first Bitcoin conference around the same time and dug into the technology behind Bitcoin, and made blockchain the core thesis of the fund when we launched 5 years ago, and built a portfolio of early leaders in that space. We're now investing out of the second fund, and obviously really thrilled at how the thesis has played out over the last few years.
Hi, everybody. Thank you, Milken Institute, for this honor to be here and to be with these panelists. My name is Maria Arisa. Up until 3 weeks ago, I was the CEO of Amexcap, which is the private equity and venture capital association in Mexico. It gathers more than 170 active funds that are investing through different strategies. Altogether, they have committed more than $54 billion to be invested in Mexico. I think I was very lucky and in the right time and at the right place. Mexico's industry really became solid, became mature on the last 7 years, and I was able to see that for myself, heading the Amex Cap for 5 years. So actually, I was before that part of the industry in a fund, and we were only basically 10 funds investing in Mexico, and with less than $800 million of committed capital. So we actually have grown a lot, more than 20% annual growth rate within the whole industry. It's been really, really amazing what is happening in Mexico. So I am now joining a new project. This is a very ambitious project in Mexico. The government has given concession for a new stock exchange for the first time in 120 years. So I think it's going to be important for the Mexican economy. Hopefully we'll see more activity within the market thanks to the increased competition that will I hope, bring more companies into the market and attract more investors as well. So basically, that's what I do now. Thank you.
Great. First of all, thank you, Milken Institute, for the invitation to participate here, talk about venture capital and venture capital in China. My name is Ron Cao. I'm the founding partner for Sky9 Capital. And we are an early stage focused venture firm based in China. We have offices in Shanghai, Beijing, Shenzhen, and some presence also in Palo Alto. We have 16 people on our team, and we raise about $200 million every 2.5, 3 years. And we're on our third fund, which was closed recently, a $200 million in commitments. So we focus on what we like to think are the biggest opportunities in China, and try to drive high impact multiples to our funds. And we think those opportunities are mostly in consumer internet, around social platforms, around e-commerce, around fintech, around any sort of consumer platform marketplaces that can transact, that can result in high level of transactions, large user bases. We also spent some time on the enterprise IT space, things like cloud computing, some of the newer trends in the data center migration to more virtualized environments, et cetera. And then we are spending more and more time in deep tech. AI and blockchain are two truly disruptive technologies that's going on around the world. In China, in some ways, is ground zero for some of those developments. So those are areas that can be very disruptive. We do a couple $1 million to $5 or $6 million Series A, and $10 to $20 million in an expansion stage capital. So look forward to the discussions.
Great. So obviously, everybody here has a very different perspective. We're going to start with some questions about the overall venture industry. And as we've talked about before we came on stage, it's clear that everybody's point of view will impact how they answer these questions. Just quickly, my background is, as it was mentioned, I co-head the technology group at Jefferies, full service investment bank. But I also spent 15 years in venture capital. I'm kind of the strange bird that came back to banking after starting my career in investment banking in the 90s, co-founding a firm called Azure Capital Partners and backing companies like VMware and Bill Me Later early on in their lives, and then came back to banking in 2015. So let me just start. So there's been, fundraising has at an all-time high. Check sizes are growing larger each year. More capital is available to private companies than ever before. And many companies have been delaying their IPOs as they continue to grow on a private basis. So are we in a funding bubble? Ella, do you want to start?
I don't think so. I think what's happening is we actually don't see as much activity, the growth in activity at the early stages of the companies. Again, I'm speaking about the US market, so please keep that in mind. We see venture firms moving up the funnel, and the reason why in the total deal volume and the total size of the industry is growing is that the companies are delaying liquidity. We see those massive rounds. I think there's been over 100 mega rounds last year, but there is liquidity given to the early investors and the employees and obviously founders of those companies in some of those rounds. So I think it seems like the industry is just reconfiguring itself, and like I think it's quite interesting to see that we've been talking so long. And I've been in tech for 12 years. I started my first software company 13 years ago. We've been talking so long that the IPO market is broken. I think we see an emerging solution to that problem in some of those massive later stage rounds that provide some liquidity. So I think it's still I think it's still where the growth is. Tech is where when you look at the top 10 US companies by market cap, I believe 7 or 8 of them are tech companies. So this is the tech industry it still produces all those future sort of top 10 companies, and I think there should be more money flowing into venture capital, frankly.
So do you think, based on what you're saying, that there's if there is a glut of capital, it's more at the late stage than it is at the early stage, relative to the opportunity set?
I think it's just consolidating. I think that's how the market is playing out, and I think that's what the market is doing. So I don't think I would feel that I should judge it. There is opportunity in those companies. Those companies are not going to IPO. I think it's smart of the SoftBanks and Sequoias and whoever is raising their next giant growth funds to get into those companies, because that's the way you get into those companies, and that's where the growth is.
Just to Ron in China, how do you feel about the availability of capital relative to the opportunity set today?
Well, there's money everywhere. There's money in China, money here. I think the thing about venture capital, I think at the extreme stages, the truly early stage, the seed level, and the later stage, in some ways you can argue those are fairly low entry businesses. If you're an angel investor, you have $5 million, you're an investor, you're an angel. And later stage, hey, there's a pre-IPO deal, I have access to capital, you're an investor, right? So those stages tend to, I would say, go through cycles that are much, grandeur in terms of, sort of money coming in and out. I would say in China, last couple of years, every single person's an angel investor, literally. So deals are done left and right.
Oh, okay.
But as the domestic IPO market that was getting weaker, and sort of general cooling last couple of years, those guys gone away, right? So I think the same thing you can make about the pre-IPO rounds. So right now, I think the pre-IPO rounds are hot again. Right, so there's a feeling for a lot of capital. For where we operate, we're really the Series A, Series B level. You have to be a professional institution with teams, insight, value added. People can sit on boards. I would say in general, at least in China context, it's still pretty healthy because that barrier is much higher. It takes years to build up the expertise. I think the U.S. I'm not as close to that as maybe some of the folks here, but it seems like there's a lot of funds raised, a lot of money. I think, so is there enough opportunity for that? I think it's, time will tell.
Jalik, if you think about what we've seen recently with WeWork's $3 billion round led by SoftBank, Airbnb raising $1 billion more from Capital G, Lyft raising $1.7 billion, and obviously a lot has been discussed about SoftBank and some of the other large pools of capital. As we talk about the industry transforming, what does this mean for traditional early stage venture?
Yeah. Well, look, I think there is a kind of glut of money at the later stage, and really doesn't make sense for people with large pools of capital to invest smaller amounts at like the seed stage. It's just as much work to work on a larger deal as it is a smaller deal. So, and we've seen all this global capital looking for alpha that they can't find in other places, and then that's where and then. Obviously, people have seen that tech companies are doing really well on the public markets, and so there's been a confluence of factors, and I'd say in the last 5 years, has led to these like mega funds that seem to keep getting larger, and I think that provides opportunity for those of us doing early stage. A few years ago, when I started Future Perfect 5 years ago, there were a lot of seed funds that these micro VCs, sub-$100 million funds that got launched. We're starting to see some have survived, some haven't. We're starting to see the returns out of that activity. And so at the end of the day, these later stage funds need to invest in something that has to be seeded by somebody, because they're not going to just go in and take that early risk. And so I actually have been never more excited about early stage venture, especially in an area like blockchain and crypto that is so specialized and is not something that some of these larger funds want to go out and spend 7 days a week necessarily trying to figure out.
Makes a lot of sense. If Maria, just as you see it in Mexico, that's an emerging venture community. Do some of these macro trends have an impact in terms of availability of capital, or it still is such an early stage in terms of the funding environment that it's all greenfield?
Well, we actually live different from the US in terms of fundraising. We struggle in terms of fundraising. Basically, 2/3 of the capital that we raise comes from abroad, and 1/3 of the capital is national. National LPs basically are formed by development banks, the government, which is basically supporting the earliest stage of the funnel. They have co-invested in more than 40 seed capital funds in the last 3 years, which have ignited this part. Basically, they have invested in more than 300 startups already. But a part of that, pension funds are really not investing in venture capital. They're only more focused on private equity and real assets, infrastructure, real estate. So we don't have a pretty large institutional investor base focusing on venture capital. As well as insurance companies in Mexico are pretty much not investing in private equity yet, and we should be, trying to get them attracted to the asset class. It's going to take some time now, but we'll make it happen hopefully. And family offices, which were the most active for the space, they have been getting more sophisticated in the time, and they have been putting their teams together and investing directly. So this leaves us with institutional investors from abroad, which have now been in an impasse moment, given the situation of Trump, given the renegotiation of NAFTA, given the internal elections that we're going to leave in a couple of months. So we have seen a little, decrease in their allocation. I mean, just in the past 2 years. And development banks, institutional development banks from abroad, they have also kind of decreased their allocation because Mexico has now given more signs of maturity and growth. So they have gone out of Mexican asset class. So, but the good news is we do have some other institutional investors from other regions, such as Asia, such as Europe, that have come to Mexico attracted by the opportunity. And I think that's going to be a very important side of the coin, right? We still have 1.2 billion so far in dry powder for venture capital, so that will give us gas for the following months, potential first 2 years, and we'll see from there. Pension funds now in Mexico have a new regulation where they can invest up to 90% of their assets outside of Mexico. Before that was not permitted, so all the capital from Afores, from pension funds, had to be invested in Mexico. Now they can raise different managers from different countries. They can raise money in Mexico and invest it outside. So that's going to put some pressure on the fundraising activity, not only for venture capital, but also along the other strategies as well in Mexico.
So speaking of sources of venture capital, I mean, I can remember in the 98, 99 timeframe during the internet bubble, corporations jumped into venture capital. There were a lot of organizations that decided it was time to invest. And then when that party went away, most of those investors went away. There were a few like Intel Capital that stayed consistently through cycles. But what we've seen, of course, is a lot of corporations now getting into venture capital. And what I'd be curious from various members of the panel is do you get a sense that that's real in the sectors that you focus on? And do they add value? Is it more of a positive to have corporate investors, or more of a negative in sense of it might limit your exits or make a company more constrained in terms of how it's going to operate?
I'm happy to start. So very early stage, I don't think it makes sense to get corporate VCs involved. What we've seen is that before a company is able to build up a leverage and build some optionality for themselves, it can be quite tricky. And we've seen, we've seen various food companies, in the sort of markets where we're active in again, synthetic biology, food tech, robotics space. We've seen very active corporate VCs. They often provide the infrastructure, and they often, I think on the surface, that they offer a lot of value-add services. Having said that, it's never good to just work with one corporate. That's the sort of general advice we give to our portfolio companies, and we've seen that play out. Like one portfolio company you might have heard about, we were early investors in a company called Memphis Meats, which is sort of following this idea that we use cows as bioreactors to turn certain plant protein inputs into animal protein outputs in a very inefficient way, with crazy inefficient energy conversion and time and land use and all the externalities you can think of. They are growing muscle cells in closed environments, here's conveniently Memphis Meats. So they actually only when they de-risked certain areas of the business, and when they've proven that they were able to lower the cost by many orders of magnitude of the per pound cost of the meat they're making, the real meat they're making. Only then, as a part of their Series A, led by GFJ with Richard Branson and Bill Gates, they allowed strategics from Tyson and Cargill. So it was important for them also to differentiate. And we've seen similar stories in our portfolio where there is corporate interest to invest, obviously, because if it's not an investment, then it's corp dev, and it's an early acquisition target for them. But that creates a lot of distraction and unhealthy pressures for the companies. And from just our 50 years is run by entrepreneurs with some successes on our accounts. Right now, just the founder of Soylent actually joined us as an innovation partner, another food tech company based actually here out of LA. We've seen these deals just being tricky to manage internally before you have the leverage. But overall, I'm excited for the fact that corporates are excited. The M&A market is there. I mean, in food, pharma, autonomous driving. I mean, we see interesting liquidity options for founders, early investors, employees, again, for everyone. So it's overall good that corporates are taking a turn.
Yeah, I think corporate venture has changed a lot. I started off at Intel Capital, as I mentioned, so we're the largest corporate investor, and also one that, as you noted, stays in it through different cycles. A lot of corporates got into the space back then, and then realized, they weren't really the best folks to necessarily manage, earlier stage portfolios. There was a mismatch between quarterly earnings and pressures and like that longer term view, and how do you really bring that innovation in from the investments. So it's gone back and forth. But what I've seen, and I've done a lot of fintech over the years, and especially post 2008, when banks didn't have the same kind of resources that they did before in terms of their IT departments, et cetera. Data started opening up more, or they were being forced to open up their data more and create more efficiencies in their businesses. So they were much more open to partnering with startups, and that could mean investing or just kind of collaborating. I actually have a lot of strategic investors in my second fund, because a lot of these companies across sectors are very interested how AI, blockchain, IoT is going to impact their business, but they don't necessarily have the resources in-house to experiment with it right away, but they can keep an eye on it through these different relationships, and some of them have ended up co-investing in later rounds. So it's I'd say the whole corporate venture sector has evolved, and is actually much more open to collaborating with startups than they used to be.
It's interesting. I'm just going to ask Ron, obviously, between BAT, you've got Baidu, Alibaba, and Tencent, and you could throw JD in there. They have now gotten to the point where they're also major investors in a lot of the technology companies that are growing up in China and globally. Do you see them as value-added investors? And if so, where?
Yeah, I mean, for sure they're value added. I think the trick is when and how do you bring them in, right? So, since 2006, we have done about 100 deals in technology. In China, I would say roughly among the deals that have broken out, close to half of those companies have taken on some strategic money, maybe beyond the BATs, but some of the other also multi-billion-dollar companies. And usually those rounds happen after Series C or Series D. So I think there was a question on the list that does the corporate money actually help the company to become really successful? I think that's a reasonable argument. You can also argue the other way. A lot of these companies are very successful, therefore they attract the corporate money because of defensive move or being part of a winner, as sort of the internet space in China is very, very competitive. But I think when is really Series C and later, where you're not giving away a lot of dilution, you have maybe some power in terms of negotiating terms, and how is really really have to, as an entrepreneur, think about what benefits you're getting from that strategic investment. Is it traffic? Is it user base? Is it technology? Is it supply chain? What is it that you're getting? And typically we want those deals to be tied to a certain type of business arrangement, whether based on trust or even based on an agreement that's in conjunction. So without the company being very strong to begin with, it's hard to negotiate those deals in a favorable way.
I'm just going to switch gears. And Maria, you and I were talking right before our panel here about exits and the IPO market in particular. And so we've seen IPO activity for a 3-year period from 15 through 17 at the lowest level in a 3-year aggregate since the collapse of the bubble from 01 to 03. So IPOs have not been very prevalent, and yet this year we've seen a shift. It's too early to call it a victory yet for IPOs, but certainly the activity in the first half of the year has been very positive, very dramatically positive compared to what we saw before. What's your perspective, given where you are today, about the value of an IPO for the entrepreneur versus, and its investors, and the investors, versus an M&A exit? And how should boards and venture capitalists think about those two paths?
Right. Okay. Of course, I mean, the stock exchange market in Mexico and, of course, in Latin America has been not very strong, as I was talking about. However, I believe there's an opportunity to serve all the mid-sized companies in Mexico, for example. There are pretty much around 16,000 companies that are out there. Basically, 1,000 of them might be part of a portfolio, private equity portfolio already, and it doesn't make any sense that we have less than 150 issuers in the market when our economy should get at least 8 times that number of IPOs. So what we're thinking is, even for the private equity, the next step for a company to follow their development, to follow their growth, whenever it's ready in governance, whenever it's ready in criteria for the exchange, to follow up with an IPO and become a part of the country's economy and continue to grow and to develop their objectives within the market. So we believe there's an opportunity there. Basically, large caps are being the only companies really targeted by the exchanges. The mid companies that are out there are not being liquid enough. So we should be able to change this position because of the private equity evolution in the region, and because we should be able to attract, of course, new type of investors, such as retail investors. Mexico has 1% of retail investors participating in the country. So it's really small. We should be able to change that status quo, I hope. And I think the overall environment should be taking us in that direction.
Any other opinions on the panel? One question: are we about to have another IPO wave in China, Ron?
I think so. I mean, it's already happening. You know, we had 3 IPOs last year from our earlier fund, 2012 vintage fund, 2 in the U.S., 1 in China. You know, and that's always been the knock on China venture capital. Where are the exits? We have 3 others pending right now. Not all of them going to go to U.S. We're going to go, you know, it's going to go to Hong Kong. Hong Kong's becoming a major player for technology IPOs. They made a number of changes to their regulation to allow for things like dual share class. Xiaomi is going public on Hong Kong, you know, there's talks about a lot of Chinese listed companies in the U.S. going to Hong Kong because the investor base there understands those stock more. And I think the upside is that China, the domestic IPO market, there's been a lot of regulation changes over the years to accommodate for tech companies going public in China, where companies are fast growth, but maybe not as profitable. So, you know, I think one of the upsides of China venture capital going forward, I think it's, you know, if someone want to be bold, make a statement, this will be perhaps the most liquid market in the world. A company that's doing well in China can list in Hong Kong, US, London, domestically, be bought by a Chinese strategic, be bought by a US strategic. You know, we've seen a lot of exits over the last couple of years, and that trend is going to continue, I think.
So switching gears, let's talk about some sectors, because we have a lot of different sectors represented in terms of what people are focusing on here on the panel. Jalek, maybe you could start. You spend a lot of time in the areas of blockchain, AI, IoT. Talk about what's particularly exciting for you in the areas that you spend time in.
Yeah, so I mentioned, you know, having been early in the internet, and I believe in, you know, technology innovations every 20 years or so, and I felt like, the internet provided connectivity, a lot of connectivity around the world. It provided, information at our fingertips, gave rise to business models built around mobile connectivity, as well as cloud computing. But it's still kind of a fairly inefficient kind of system in place, infrastructure in place, when you start to think of those 4 billion more people coming online. They're going to be coming online with smartphones and devices, kind of leapfrog, even the phones that we have here. We're going to have billions of machines communicating with each other. And the way we're structured right now, information has to go to servers and then back out. And I felt like we're going to start to have more decentralization of computing, and the Moore's law, the processing power getting more powerful was going to allow that peer-to-peer connectivity, device-to-device connectivity that wasn't possible before. And so it's like a convergence of like macro factors in the world, and then technology developments where I thought, the time is kind of, it's a perfect storm for something like blockchain technology, which does not kind of require intermediaries to conduct transactions. And we think of Bitcoin as, a currency transaction, but you can apply that to data. And at least the Bitcoin blockchain is highly secure. So it's keeping our data secure on a global database that we can, if we own the keys to our data, we can start to permission it out however we want to, whether it's a company or an individual. Now, we've all heard about what happened with Facebook, right? A lot of Silicon Valley, I'd say, missed the last 5 years of kind of crypto and blockchain development because they're so focused on business models that focus on like hoarding data, this, and now we're moving to a world where data is just going to be more open, and the consumer is going to be more in charge of that data because of the technologies that enable it. So I just saw this opportunity, and I just got back from 2 weeks in Mumbai, London, and Beijing, and what's happening in China. While they've banned crypto, they're putting billions of dollars of government money into blockchain infrastructure and seeing how it can impact supply chain, food tracking, food security. So every sector that was impacted by the internet will be impacted by blockchain. And the countries and companies that see that sooner rather than later will be the next generation, Facebook and Google and Ubers. And I would say 5 years ago it was considered very radical to think that way, and it's almost week by week. There are more pilots that are coming out, proof of concepts that are now turning into projects. The Australian Securities Exchange announced after a 2-year pilot that they were moving their post-trade settlement systems to a blockchain system, and they're going to implement it within the next couple of years, which is much sooner than most people had expected. And so things are moving quickly in the sector.
Ella, you invest, you talked about a generalist approach to investing. Do you see blockchain impacting some of the sectors that you invest in more aggressively than others right now?
As a fund, we're excited about blockchain, and as an infrastructural layer for new internet, I think we just starting to invest in that space, not in VC rounds, which are competitive, as some of those people on the panel know here. We don't see them. I'm not yet as excited about the applications, blockchain for food, or yet about the tracking applications and even the transparency. I think they're just too early. The ecosystem is being built out. I think the developer community is. We need a whole set of developer tools, and we need a whole security layer, I think, before those applications are going to be exciting for us. What we're looking at, and I think the general question about the things we're excited about, I think at 50 years so the name 50 years, and I think that adds a little bit of perspective to to our work comes from this essay that Winston Churchill wrote in 1931. The essay was called 50 Years Hence. And in that essay, he was, after a few years of talking to scientists and his colleagues, he was mapping the trajectories of science, of technology, and macro trends in the world. And he predicted that within 50 years from 1931, certain things would happen. And he essentially predicted synthetic biology. He predicted genetic engineering before we even really understood what genes were. He predicted abundant nuclear energy, wireless communication. He was actually the first person to talk about lab-grown, clean meat. So and then the second part of that essay, importantly, he talks about the social responsibility for technologists and scientists and politicians as well, but people who are creating the world for the rest of us to take a principled approach to what we're doing. And on a philosophical perspective, the shift we see is that the new generation of millennial entrepreneurs, the smartest PhDs, the people working on the coolest research out there, they really want to apply it to solving the world's biggest problems. So we are an entrepreneur-run fund that helps them be a partner also on that mission. And within that philosophical change that we see different technologies used for solving all sorts of problems. So in terms of what we're excited about within this sort of general framework of solving big problems, what we see, for example, in synthetic biology, what is this amazing potential for using biology and editing directly the code of life, and the recent developments and the lowering costs of sequencing and sequencing a genome and gene synthesis and the race in robotics labs and developments in AI enabled an entire industry and obviously CRISPR enabled an entire industry where we can make products with the use of microorganisms, so make them in a totally different way than they have been made before. So that's one of the areas that I think we'll see a lot of growth. And it's just really exciting how that field is developing. Where it started, let's say 10 years ago when Synbio showed up on the venture map. But right now we have organism engineering companies. We have companies providing data for those companies. We have we have mapped the microbiome. We have mapped the genome, not just the human genome, but the genome of multiple organisms, and that creates very interesting innovation cycles where new products can be already taken to markets. And we have also the fermentation scale-up and the robotics scale-up needed to actually make those turn those into business. Cash-generating businesses faster. So that's quite exciting for us.
Yeah, we did a conference a few weeks ago, and one of the interesting things on the internet side that most investors asked for, well, actually, it was the two topics that people asked us to spend most time on. One was blockchain, and the other was food tech. And so not surprising to hear both of those as areas of focus. Do you think I'm hearing, particularly in the agricultural side, a lot of VCs still don't have the resident knowledge to understand that, particularly if they're coming from a traditional IT perspective. Do you think that's one of the challenges for the industry in terms of follow-on capital? Or do you think there's enough capital out there with sophisticated investors to understand some of these new areas?
I think AgTech is harder. So there's food tech and AgTech. They're separate. So with food, I think there is going to be a lot of follow-on capital, and there's already a lot of excitement for how we can, which technologies can be commercialized. So we have a broader spectrum of alternative proteins, which consumers and markets are asking for. So we can lower the cost of producing and processing plant proteins so that we can, there's a huge opportunity in functional foods. And I think there's appetite both on the later stage. We see a lot of excitement and appetite on later stage investment scene, and also, you know, the big food companies are very excited to acquire those companies at very promising valuation. So that I'm more optimistic about. In terms of agtech, it's hard because it's a very consolidated market. So when you're selling to farmers, one thing is to build a technology that, you know, helps the microbiome, like helps, nourish the soil, or helps pick produce. And it's the second. It's a totally different question how you sell it and how you actually and who buys that technology. So we think this is and what is the defensibility of that technology, because some of those things are hard to build but easy to copy. So there we are also a little bit more careful.
So I just want to switch up, but on a related topic, because I'd like to hear from you, Ron, and Maria, what areas you're focused on. Ron, you and I talked a little bit about how China has evolved into a highly innovative area for all things technology. And in some ways, we feel coming from the US that we're trying to catch up to China. Can you talk a little bit about one or two areas where you think there's a huge opportunity from an early stage investment perspective sitting there in Shanghai?
Yeah, well, I mean, we focus on three areas. One is consumer internet, two, enterprise, and three, deep tech. I would argue, and it's not even an argument, I think it's more of a fact. I mean, the Chinese internet market is the most sophisticated market in the world. And enterprise market is still predominantly US play. China is pretty far behind. In the deep tech space, AI, blockchain, it's a race. I mean, there's two ground zeros, China and US, in those two areas. It's a race, and I think with AI, I think the US has a lead. China's catching up because it's got access to data, user base. I think blockchain, because of the regulation environment in US, I would say, I think China will probably move ahead in that whole space, even though ICOs are banned, organized exchanges are banned, but the government is very much behind that technology and making various investments. So we're spending a lot of time on blockchain. In fact, we made our first token investment. This is the first time a fund, at least one of our funds, that invests in something that's not equity, but it's equity-like in terms of return profile. So I think we'll do more of that. Because blockchain at the fundamental level really represents two things. One is the building of the decentralized internet. That's a very powerful thing. Everything we know today is based on a centralized system. Two, it's really the digitalization of assets. That's a very powerful thing. Assets can be traded. So we're spending a lot of time in that space. And the other area is really consumer internet plays. New social apps, e-commerce platforms, fintech plays. There will continue to be very big opportunities there, even though they have already been big opportunities. Some of them we participated in because the market is so massive, and also the China market is so unique in that there's no legacy system. So we're moving from no system to the brand new system, and consumers in general are very comfortable using new technology, very savvy, very willing to try. So there continue to be very exciting opportunities there.
Maria, I want to ask you the same question, and I'm just going to put the audience on notice right after this. We're going to ask questions in case you have a few.
Mexico it's a little behind in terms of blockchain and all of that. And of course, we have other type of necessities as of now. I mean, there's a need of financial inclusion in our country. More than half of the country is underserved in terms of access to financing. Percentage of credit as a GDP, it's only 35%. So compared to other Latin America countries where you can see more than 80% GDP coverage. So it's really, there's a lot of opportunity for fintech in Mexico. We just passed a law. This is the first country that has a fintech law. And that, of course, gives certainty for investors. And there's a lot of need in terms of mobility. Of course, that's also another key sector for Mexico. Also, e-commerce. It says in 2021 we'll have more than 90 million people using internet, over 130 that we are. So this gives a lot of edge for a platform for e-commerce in our country as well. And we are graduating more than 130,000 engineers per year in Mexico. So the IT software also are industries that are being targeted by investors abroad, since Mexican talent is competitive. So I think those are the main industries that we're seeing more active within the venture capital industry. Well, of course, agriculture as well, agri-tech. We export basically more than half of what we produce. We'll see what happens after NAFTA.
Any questions?
Thank you very much. If possible, I'd like to ask 2 questions. Is it okay? Simple question. The first one is that when you decide to invest, how do you take account SDGs, Sustainable Development Goals? This is the first question. And the second one is that I'd like to ask each panelist to point out the biggest risk factor of your company, considering your investment portfolio.
It's the easiest question for us. We're specifically, the way we map the biggest problems in the world at 50 years, it's roughly based off of SDGs. There's some addition of X risk and animal welfare as a big need. But every single investment we make, we want to know that a given technology at scale can significantly contribute to achieving one of the SDGs. Because we believe that translates to not only how impactful it will be in the world, but also the business potential that it will have. So if you go through our portfolio of 42 companies, as of now, every single one is addressing 1 up to 5 SDGs in a very meaningful way. Obviously, if they're able to scale up the technology and if they end up being successful.
Anyone else?
Yeah, I mean, we don't map it, but one of the reasons I launched the fund was because I believe that the most successful companies of the 21st century will be the ones that are solving, a lot of the challenges that we face, and the entrepreneurs that are mission-driven are going to attract the best teams. I mean, I've seen over my career how more and more people have decided that they want to be focused on impact and mission-driven ventures. And to me, that's why I got into blockchain technology. To me, it provides access to 1.5 billion people who don't currently have identity, 2 billion unbanked, and then all the potential to create micro markets and peer-to-peer connectivity. And I also strongly believe that we need more kind of diversity and role models in all industries. And to me, the best way to impact that was to actually be that role model.
Maria?
We didn't answer the question on the risks. I didn't. What was the question? Was it on the risk of the thesis or the portfolio company?
What's the biggest risk factor you see? I think that's the question. It's like, right, in deals.
Yeah.
What are the biggest risk factors in the deals that you see?
I mean, given the space we're in, we've seen a lot of regulatory movement. I actually welcome that, and I've been talking to regulators for the last few years, educating them on the technology, because I believe it's better to have positive and some regulation and some clarity around that than just operate in a vacuum. We saw what happened last year with thousands of initial coin offerings that just popped up in a completely unregulated environment. I don't think that's a good thing for the sector, and so I'm glad that regulators have come in. I only invest in entrepreneurs who see that perspective and understand that good regulation is better than no regulation, and eventually with the risk of shutting down. But early stage it's risky, and that's why you have a portfolio. But I also am not a believer that only 2 companies out of the portfolio can do well, especially when you're investing in mission-driven entrepreneurs. You can get that success rate much higher, and that was also another reason, and kind of prove out that thesis and have a higher hit rate. I think that actually helps provide more employment and more diversity of thought out there if you have 80% of your companies survive versus 5 or 10% of your companies survive.
Maybe I'll just do a quick answer on that as well, because I think those are 2 really good questions. I'll go in reverse order. I mean, the biggest risk factor we see is people. It's absolutely people. We make returns based on people. We lose money because of people. There's plenty of ideas, plenty of technology out there. And one of the things we look for, one of the experiences we learned over the years, I think one factor really we focused on is really authenticity. That word, I think, captures everything that we look for in an entrepreneur. The question you want to really ask ultimately is this guy for real? Is this person for real? Does he truly believe in what that vision is, right? In address to the first question too, it's the ones that really make it big. Certainly there are timing issues and all that benefit helps the company become big. But the ones that really make it big have really a vision that's beyond themselves. It's for society. It's for the greater cause. So those companies tend to be more sustainable. Can last through the downturn and overcome difficulties. So it's really a people business we're in.
I would say, for thinking on the exchange, maybe I would go for the risk of not having rightful information at the time updated, and of course the cyber risk out there that is becoming even more dangerous than years ago. So we have seen that that part of the risk being taken care of by the regulator with closer eyes, and I would say, basically information and cybersecurity.
Can I just add one thing before we close? I didn't comment on the risk. I agree with the people risk. It's early stages of investing in people. We specifically make sure they care about the vision is grand and they're going to stay at it for a while. People burn out, and to be able to attract the best talent, you need to be in it for other reasons than financial. I think to really build those future massively profitable companies and massively important companies. We invest when some level of technology is already de-risked, but we often like to trade the market risk for early stage technology risk still. So there's a little bit, usually by the time they get to the Series A, they have de-risked the technology to where they can show it can actually, they can get to the right unit economics where that is a business, but because we like the markets where if you deliver, the market is already waiting and hungry for the solution, we often trade market risk for technology risk. So yeah, and for us as a business, the biggest risk for 50 years as a as a company is that we will miss out on the new wave of important technologies. That's why we're a generalist fund, and that's why we talk to academia a lot, and we go to universities, and we map, what's coming out of academia and when it's ready for VC money.
So I want to, first of all, thank the Milken Institute for having us. I have just a 10-second wrap-up, one-word answer to close. All VCs are optimistic by nature. So the question is not whether you're optimistic or not. It's whether you're more optimistic now than 3 years ago. Yes or no?
Well, by far.
By far, yes.
Absolutely.
Yeah.
There we go. Thank you very much.
Thank you.